Hey, Sean Devlin, the mortgage shoes man, 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 shoes man. Hey, Sean Devlin, the mortgage shoes man. Hey, Sean Devlin, the mortgage shoot man, coming at you with Thursday's thoughts. And today, we're talking about mortgage broker compensation. It's going to get a little juicy in here. Join us in creating excitement about how to interpret the lending law for broker compensation, loan officer compensation, and whatnot. Now, I got to tell you up front, a lot of my interpretation and Thursday's thoughts here in this video are going to be based on TPO, third-party origination. If you're a direct lender to HUD or any other aspect of being a direct lender with a line of credit or having a direct ticket to Fannie, Freddie, Ginnie, or otherwise, please do your own due diligence. So, I'm going to talk about comp today. I'm going to dispel some myths about some common questions. And here we go. We're in the year of 2018, and a lot of mortgage brokers are coming back into the market. They had been for the last 2 years. And more mortgage brokers are opening shop every day. I love it. And I can't wait to help as many people as I can. And one of the things that I strive to do is provide clarity, resources, and a little bit of general knowledge on how to set up their business so they can grow and be compliant. Well, let's talk about it. I'm going to read some things as well today, straight from the law book. I'm going to put the book, literally it's like 530 some odd pages, and I've read it like 15 times in the last week just for this video. So, I will tell you, again, disclaimer, ladies and gentlemen, I'm not a lawyer. I'm an account executive. I help mortgage brokers and third-party origination as a lender rep to help brokers close more loans, source new business, and ultimately grow their mortgage company. So, in order to do so, there's a couple of things you need to know. Number one, if I call any one of the loan officers that are in my roster, any one loan officer should not be able to tell me that they're not going to send me a loan because regardless of my price, they're going to get paid indifferently somewhere else. They can't do that. So they should be paid the same amount on every deal based on a percentage of the credit issued. Now, there's a couple of proxies to this. I'm going to go over that. Proxy is a word that they are going to use inside the law book. I definitely suggest you check it out. I'm going to make a post of it today inside of Sales Talk with Mortgage Pros. But let's go over it real quick. So, it clarifies the definition of a proxy to whether, one, the factor consistently varies with a transaction term over a significant number of transactions. That's number one. Number two, the loan originator has the ability to directly or indirectly add, drop, or change the factor in originating the transaction. So, you should be paying these guys, any one of your loan officers, a set amount, a set percentage. There's a couple of ways I'm going to break down this law. So to help you broker owners structure a comp plan. So, number one, myth. You have to be W-2'd. No. It specifically states, the final rule amends this restriction, but provides an exception to allow mortgage brokers to pay their employees or contractors commissions. Although the commissions can now be based on the terms of the loans they originate. Very self-explanatory, written in English. So you can 1099 people or you can W-2 people. That's up to you. Unless you have specific state law that you must abide by. So it's only like, I think, 2 states that have a state law. Let's say you have to be W-2'd. But upfront charges, another common question. So, are you allowed to pay like an appraisal or credit report and take those fees in advance? Yes. Specifically says the third parties usually charge fees for commissions or services they provide, for which may be paid directly by the consumer from the loan proceeds or indirectly through a creditor or broker. Consumers may also incur some third-party fees in connections with a mortgage application, such as fees for an appraisal or for a credit report. These may be paid at origination or in some cases at closing. Specifically states that. All right. Pay based on a percentage of a loan amount. Let's bring this up as clarity. It states that the amount of credit extended is not deemed to be a transaction term or condition, provided that compensation received by or paid to a loan originator, directly or indirectly, is based on a fixed percentage of the amount of credit extended. The provision also states that such compensation may be subject to a minimum and a maximum. If you don't know what that is, I will tell you a minimum and a maximum is a great way to set up a compensation plan with a lender, such as myself. It allows you to stay competitive on large loan amounts and make enough to make sure the overhead is taken care of on lower loan amounts. So a min and a max. Please see me if you need further clarification. Now, how else, besides the percentage of a loan amount, the amount of credit extended, can you pay an originator? Well, says clear as day, bonuses are permitted. Let's go over it. This provision also states that nothing until the section prohibits incentive payments to a mortgage originator based on the number of residual mortgage loans originated within a specific period of time, which is generally consistent with the interpretation provided, until it. Now, it also breaks down to say, the final rule permits compensation under non-deferred profit-based compensation plans, including bonuses, to be paid from mortgage-related profits if such compensation for an individual loan originator does not, in aggregate, exceed 10% of the individual loan originator's total compensation. So, can you incentivize your loan officers a bonus based on volume? In other words, total number of origination over a period of time. Yes. As long as the bonus isn't more than 10% of the individual loan originator's total compensation for that period of time. Pretty self-explanatory. The 10% rule is a good one to know. All right. Lowering comp. Are you allowed to go from lender paid to borrower paid? Heck yeah. But there's provisions to this. Let's talk about it. So, I'm going to read what it says right after the book. In other words, such an approach could incentivize creditors to systematically overestimate pricing in all circumstances and make selective concessions of which loan originators would bear the cost for the sole purpose of avoiding high-cost mortgage triggers for non-compliance with federal ability to repay provisions. So, it specifically gives 2 examples for which you can, and one specific example which you cannot lower your comp. So, in all the legal mumbo jumbo, I can tell you that it absolutely says there's an unforeseen circumstance for which the cost of the loan increases. The loan originator is allowed to change from lender paid to borrower paid and lower their compensation. That is allowed. However, you're going to have to document that. And I think a lot of lenders out there would need to perhaps create policies to create some sort of way to document the fact that they allowed a lowering of the compensation to defray cost. And it was based on an unforeseen event or cost. It gives specific examples, such as a lock expiring due to an issue with title, and title, prolonging the loan. Lock expires, and then the loan originator wants to relock the loan and then lower his comp to take care of the relock charge. That would be allowed. Also gives a specific example of when there is a cost to cure based on tolerances. And loan originator needs to lower the comp in order to take care of the tolerance. Is that allowed? Yes. In both examples, you need to keep on file some sort of documentation for a period of 3 years that ultimately would help an auditor indicate that there was unforeseen or a main reason to do it. Now, it specifically gives an example that in lowering comp, whether they may reduce their compensation to bear the cost of pricing concessions made to avoid the triggering of federal and state high-cost mortgage provisions, or to ensure that the credit transaction is a qualified mortgage under federal ability repay provisions, as certain industries did want to have, certain industry commentators did want to have this, but they say that they cannot do this because the rationale is that loan originators would abuse this and they would basically overestimate pricing in all circumstances. So if you fail or have a high cost test inside one of these lenders portals and you run it and it shows that you fail, you should not be allowed to lower your comp. Or if it is found out on an internal side that you fail, there's no way the lender should be able to allow you to go to borrower paid under any circumstance. It pretty much says 100%. You can't do that. So you need to know these estimates up front more than ever before. All right, let's continue to go. So, pay based on tenure. Can you have a loan officer comp and then a senior loan officer compensation? Yes, you can. It says, to provide an example of the application is proposed a proxy definition to address whether compensation based on loan originator's employment tenure would be considered a proxy for a transaction term under the proposed definition. The proposal explained that this factor would likely not meet the first prong of the proposed proxy definition because the employment tenure would likely to have little correlation with a transaction term and thus not be substantially correlated. Can you have a loan officer commission structure for somebody who started, and then say you make something in your compensation agreement that said once you hit $3 million a month for 2 months, you graduate to a senior level pay? Can you do that? Yes. Anti-steering. Safe harbor. Let's talk about it. It's a big one. I'm a big proponent of this. I believe the loan officers don't do this enough, or they think it only applies to like borrower paid or some whether it's lender paid or borrower paid, one way or the other. My opinion is you should be showing every client 3 options, no matter what. Pretty self-explanatory. It does give the definition of this in there. However, it does state, says, to qualify under the safe harbor for each type of transaction in which the consumer has expressed an interest, the loan originator must present the consumer with loan options that meet the criteria for which the loan originator has in good faith belief that the consumer is likely to qualify. So, the criteria are the loan with the lowest interest rate, the loan with the lowest total dollar amount of discount points, origination points or origination fees, and the loan with the lowest interest rate without any neg-am, prepay, balloon, etc. So, if you showed the par rate, a no-cost rate, and the lowest rate that they could get, assuming they qualify, with paying a point or 2 and still pass QM, you can show those 3 options. You should be showing those 3 options on every single deal. Do you need to show for safe harbor and anti-steering? Do you need to show a VA loan, an FHA loan, and a conventional loan? No, you do not. If you showed one product that they seem to qualify for, which is FHA, you would be able to do a no-cost loan, a par rate, and a rate that's the lowest they could qualify for, paying some points. So you should be doing that on every single deal. You should also document that, in my opinion. Okay? All right. Now, this is going to be a little super juicy. Here we go. We're at the end of this specific segment. Okay? Sorry, this is longer for those of you watching. This is not my typical length of video. But there was definite need for clarity on these things. So, the Bureau is adopting the substance of the comment as proposed for further clarifying when there is a compensation policy in place and the objective facts and circumstances indicate the policy was followed. The determination of whether compensation would have been different if a transaction term has been different is made by analysis of the policy. A comparison of multiple transactions and the amounts of compensation paid for those transactions is generally needed to determine whether compensation would have been different if the transaction term had been different when there was no compensation policy, or when a compensation policy exists but has not been followed. So, it's provided to intend that loan organizations, creditors, and other persons that maintain and follow permissible loan origination compensation policies, greater certainty about whether they are in compliance. So, if the loan originator's compensation was calculated on an estimated hours worked for a specific product, or by any other methodology to determine time worked other than accounting for actual hours worked, methodology would be permissible only if it did not meet the definition of a proxy. Okay, here we go into the definition and the biggest question. Permitting a creditor or loan originator organization to establish different levels of compensation for different types of products would create precisely the type of risk of steering that the Act seeks to avoid, unless the compensation were so carefully calibrated to the level of work required as to make the loan originators more or less indifferent as to whether they originated a product with a lower or higher commission. So, got a little unless in there, and you got a little definition in there. All right, here's the bottom line. Can you have different comp plans with different lenders? Well, based on this answer, the answer is yes. However, how you pay your loan originators, it must be based on a percentage of a loan amount, the credit extended. So, you must have a written policy that states that your loan originators are paid X on every single loan, and it's based on a percentage. Whether you as a mortgage broker set up your business to get paid 2.5%, 2.75, or 1.25, wouldn't matter. As long as you paid the loan originator 1 on every single deal, let's just say that was what it was, that's your agreement, and you paid the originator the same amount on every single transaction, you would be okay. So, it also states, different compensation for corporate loan origination organization branches from creditors could create steering incentives. So if you have a branch, you cannot have various different compensation plans. Can't work that way. If you're a mortgage broker and you don't have a specific set amount for every single transaction, and you are just doing some sort of percentage of the loan amount, but yet your compensations vary from lender to lender, you are doing it wrong. The only way that you could potentially have various different compensation policies with different lenders at different amounts is if you had a compensation policy internally to pay a specific amount to loan originators. You can have different levels of compensation for their tenure, a senior loan officer or a regular loan officer that just started, for example. You can also pay bonuses based on the total overall volume that they do on a monthly basis. So if they exceed a certain amount, you give them additional incentive, as long as it doesn't equate to 10% or more of the overall loan originator's commissions. I want to read one more time the proxy definition that I read in the very beginning. So the rule further clarifies the definition of a proxy to focus on whether the factor consistently varies with a transaction term over a significant number of transactions. So, if you can clearly see and be audited that you have several FHA loans for which they were paid different amounts, and then the loan originator has the ability, directly or indirectly, to influence that based on them steering it to a certain lender, you've got an issue. So, it all depends on how you set it up. Now, could a mortgage broker decide on a one-off transaction that he wants to charge his mom $1 borrower paid to do a loan? Absolutely, he can do that. A mortgage broker can, for sure. Because it's not going to have a consistent varying over a significant number of transactions. You only got one mom, probably only does one loan, right? Every 10 years maybe. So, this is a little bit of white and gray area here. You know, I'm a proponent of making sure that mortgage brokers set up their stuff right. And if you're a one-man band mortgage broker and you have various compensation plans with various different lenders, I would not have various different compensation plans. I would suggest you have the same across the board. If you have an organization where you have 10, 15, 25 different loan officers or 100, and you want to set up different compensation plans with different lenders, you can do that. Just as long as you have a compensation agreement for the loan officer to pay them a specific amount. Now, I'm going to go over the specific ways for which you can absolutely pay a mortgage originator. Ready for this? There's quite a few. Check it out. It says, compensation based on the following methods are permissible. Loan originator's overall volume. You can absolutely do that based on a bonus. The long-term performance of the originator's loans. Interesting. An hourly rate to pay and compensate the originator for the actual number of hours worked. Whether a consumer is an existing customer or a new customer. So for those of you wondering, could you pay differently based on whether that loan originator self-generated that lead or you provided it? You absolutely can. A payment that is fixed in advance for every loan the originator arranges for the creditor. The percentage of applications submitted by the loan originator to the creditor that results in a consumed transaction. The quality of the loan originator's loan files. And a legitimate business expense such as fixed overhead costs and the amount of credit extended are all permitted. It doesn't give 100% clarity. It just doesn't. Okay? It does, but it doesn't. There's a lot of lingo in here that I would suggest you read it. Okay? This is almost 30 minutes. Probably one of my longest videos that I'm going to absolutely publish. I'm a big proponent of making sure that loan originators are paid the same. If I'm an AE and I call a loan officer can't tell me and should not be able to tell me that I'm sending it to X lender because I get paid more. Not allowed. I wish I could tell on you. Seriously. That hurts my feelings. Second, a broker seems to be the only one, again, from my initial commentary inside where this all started, that could potentially have a comp plan, a broker owner that potentially can have a way to have different compensation levels with different lenders and be paid differently. If you're a one-man band, you want to really, really stay in compliance, I'd suggest you set it up with all the same across the board. Be competitive, and know that proxy rule, the definition of really what is going to throw big red flag is having the factor consistently vary with a transaction term over a significant number of transactions. That's a big one. So, my name is Sean Devlin. This is Thursday Thoughts. I really wanted to provide some clarity on this stuff. I hope you got something out of this. So I have a new little feeling of my original answer was yes, a broker owner can, but I think after rereading it again and again and again, I've come to a new conclusion that I know a buddy of mine, Andy Harris, will absolutely appreciate, that loan originators, broker owners included in that definition of a loan originator should actually have a set amount that is predetermined that they are going to get paid on every transaction. Remember the proxy rule, it can't vary consistently. Can it vary once in a while? Just not consistently? Yes. However, there is the unless rule that I read. They leave a gray area there, unless, this, that, and the other. So, again, I'm not a lawyer. I would suggest that you seek your own advice and counsel to set it up, to be absolutely compliant, 100%. You could set it up the same across the board. If you are paying loan originators a set percentage based on the lender paid comp and then just charging them a per file basis. The only way that would be acceptable is if the lender comps are the same. You cannot have different varying compensations consistently. So again, a loan originator should not be able to tell me they're not sending me a loan because they're getting paid somewhere else differently. It's not fair. Let's level the playing field across the board and let's have it be about service, about serving the client. And that's what it's about. My name is Sean Devil in the Mortgage Shoot Man, coming at you. Long one, sorry, 30 minutes. But this is going to go in the books. Have yourself a wonderful one. Share, interact, like, repeat. Have yourself a great day. So, well,